I'm Laura and I work in the client services team here at Reyker. I'm joined by James Chu today to talk about our latest launch on offer.
Laura, I think this is our 24th launch already. Yeah. Well, this launch, the plan name is the Initial Accelerator Deal Index Kickout Plan. Details are on our website already. But I think you've got a few questions for me today.
Yeah, absolutely. So typically structured products pair the FTSE 100 and the S&P 500. This launch in fact pairs the FTSE 100 and the Euro Stoxx 50. Is this unusual?
It's a great question, and a lot of people ask this question as well. A lot of the advisors and investors in these structured investment plans know that for this deal index kickout strategy to work, the two underlying indices need to have very close performance. The performance should be in line with each other. Technical jargon is to say that these two indices have very high statistical correlation. Now, we did some tests and look at the FTSE 100 index, which is for UK stock market, and Euro Stoxx 50, which is for the Eurozone stock market. I looked at the calculation this morning on Bloomberg on the statistical correlation of these two indices, and the number is 0.85. And I did the same calculation with FTSE 100 and S&P 500, which is the more popular index being used. That correlation is 0.68. Now, it may come to a surprise to a lot of people that FTSE and Euro Stoxx 50 are so correlated. But you think about it, the government has some statistics, and they say that actually UK's biggest trading partner is Europe. So the two markets are quite interconnected. So it's not surprising that they have high correlations. Now, we also run some back testing, historical simulations on how this product would have worked since 1984. The back testing results are available on request from IFAs. But just to tell you, basically, this plan has a 67% chance of kicking out in year one. And it only have this high chance really because historically, these two indices, FTSE and Euro Stoxx 50, has quite a high correlation. And if that happens, again in future, bear in mind that past performance is not a good indicator for future performance, then at year one you get 13%. If it doesn't get kicked out, it accumulates at 10% per annum until the next kick out day.
Great. And so can you tell me a little bit more about the Euro Stoxx 50 index?
Sure. I think everyone's familiar with FTSE 100, benchmark blue chip stock market index for UK. Euro Stoxx 50 is similar index for Eurozone stock market. It's have the largest 50 stocks in the index. Basically, they're all blue chip companies. They are weighted by market cap in the index. And just to give you an indication, currently about 31% of the shares in the index are German and 38% are French. So then, in fact, if I remember correctly, there's no Greek stocks or anything like that because they're weighted by market cap. So strong companies in France, Germany are predominantly driving the market performance of this index. They include familiar names like BMW, Philips, LVMH, Siemens, etc. Again, if you need more information on an index, feel free to contact us. We got a lot of information about this index.
And so if this plan kicks out in the first year, there's a potential 13% return on the investment. Is this too good to be true?
Well, you're not the first person to ask this question. Well, structured products in general deliver a high potential growth because it needs the market to perform in a particular manner to get that growth. So in other words, you as investor must have a market view that agrees with the products, and if your market view is correct, then you get the best outcome. However, if you do not agree with that market view or have a different market view, then this product may not be suitable for you. Now, for this particular product, the growth will only be returned when kickout is triggered. Kickout is only triggered if both indices are at the starting level on any kickout day. So, in other words, if the index have a flat performance or slightly positive performance, sometimes called a neutral market view, this is where the product was best. Now, if you have a different view, for instance, you think that actually the market is going to be bearish, you think that the UK or the Eurozone stock market is going to drop a lot over the next 6 years, then this product may not work for you. So you need to consider this market view before you invest. And we have a lot more information about the suitability of this investment now on our redesigned application pack, part 1 and part 3. Please read through. Again, if you need help, just contact us.
Yeah, well, thank you, James Chu, and thank you for listening. More information is available on our website. The brochures and the new style application pack is available. Details of that are at the bottom of the screen now. So if you have any questions or comments, please do not hesitate to get in touch. Your feedback is really important to us.
Thank you.